And in terms of basically the portfolios, we have different performance measures. So one thing is basically an expected return. So expected return is basically the weights which sum up to 1 times basically the times each asset's return. So this gives us basically expected return of the portfolio. And another thing is volatility. Volatility is the square root of the variance. So this is square root of variance, portfolio variance. And another thing is basically Sharpe ratio. In Sharpe ratio, so volatility is basically square root of the variance. They are both used for risk purposes. So this is risk of the portfolio. So it shows us how much does the portfolio value or the return fluctuates over time. So that's why the fluctuation, measure of the fluctuation over time is a measure of risk. So we have one term here, return, which is the return that we want to get from the portfolio. Like we want to get 10% return, 20% return. But on the other hand, once we get the return, in general, we are also increasing the risk, meaning that we may not get such return. So that's called in general in the finance as the risk. And another term that we are used, performance measure, is Sharpe ratio. The Sharpe ratio is basically used a lot. So it's basically expected return per unit of risk. So in the upper side numerator, we have the expected return minus the risk-free rate. So in many races, risk-free rate is like a benchmark. So what's our return with respect to the benchmark? And in many cases, risk-free return is the interest rate on 3-month US Treasury bill. So the risk-free rate assumes that it's the riskless. So people assume that the US will not default. That's why if we invest our money into 3-month Treasury bill, we'll get a lower return, but it will be a riskless return. That's why it will be used for risk-free rate. Again, in the basically the numerator, we have this return minus risk-free rate. And in the denominator, we have this volatility. So this is not variance because variance is a quadratic term, whereas return is a linear term. By taking the square root of this variance, we are kind of making them in the same dimension. And it's the expected return per unit of risk. So basically, if we get a higher return per unit of risk, then this is something we expect or we want to get. So higher Sharpe ratio is better. And another thing is information ratio. So it's information ratio. Again, it's same as the Sharpe ratio, but instead, in this case, we don't have the risk-free rate. We don't have the benchmark. And it's basically just the mean expected return divided by per unit of risk without considering the risk-free rate. And another parameter in terms of the performance measures. So these are the ones that whenever we have a portfolio, we historically backtest our portfolio. And these are the metrics that we show our results at. And one thing is drawdown. And drawdown is basically a decline from a historical peak of the cumulative profit. So in this case, basically for given T point, so it's the maximum decline given the historical peak at the previous time step. So for instance, if we have a return like this, so this is basically the price, the profit that we are making, and this is the point. So for this point, the drawdown is basically the return with respect to point A and point B. For point B, drawdown is defined with respect to point A. So it's a measure because it shows that from the peak of the market, how much we have lost. And assume that this XT is a cumulative profit graph. So we started with 100, then by increasing the return, our portfolio has increased. So in this case, assume that this is 150, and then it decreased to basically the B, which is 75. Then this means a 50% drawdown. 50% drawdown. 50% drawdown. And another metric is value at risk and conditional value at risk. Those are two other metrics. So value at risk is basically, it's the quantile of the loss. So what we do here is we plot the distribution of the returns. So assume that we have a portfolio, and for daily, we are measuring the returns. And as a result, we get a distribution like this. So this is, in this case, the x-axis is basically the return, and y-axis is the count. How many times we see such return. So this is count. And in this case, the VAR is mostly defined at 5% threshold. And it's basically the loss that we are losing the 5% of our money. So whenever this area is 5% in this probability distribution, the return value giving us this 5% area is the value at risk. So it's basically the value that we are expect to lose more than 5% of our money. And again, in general, 5% is used, but sometimes 1%, and in sometimes 10% is also used depending on the scenarios. And again, these are the performance measures. Sharpe ratio is quite important. It's basically everything that it's basically one of the performance measures we use for the portfolio.